Microsoft's bid to buy Yahoo for $45 billion has privacy groups concerned about privacy and some stockholders concerned about value. The deal would create a near-internet duopoly in online advertising, giving Google and the merged Microsoft-Yahoo a lot of power in the online advertising market. But to avoid regulatory scrutiny and to win over Yahoo shareholders, Yahoo's board could demand Microsoft pay at least the company's 52-week intraday high, and that would be $34.08 a share, and that's about 10% above Microsoft's current $31 a share offer. Now, here to talk more about the hurdles in front of Microsoft and Yahoo are the CEO of the M&A Advisor, Roger Aguinaldo, and David Widener of MarketWatch. Welcome, guys. Well, David, tell us first, how closely is the street paying attention to this deal?
I think very closely. You know, there's for some of the reasons you already mentioned. I mean, the valuation is critical. You also have a bear hug type offer out there. That's kind of, you know, when you're talking about $44 billion, that's pretty serious. And I think that when you talk about bankers, M&A bankers, they're excited to see a multi-billion-dollar deal in the market again.
Yeah, like it is like the largest tech deal that's, I think, ever been announced. Pure tech play.
Pure tech play. Yeah, I would think it's
because I know AOL Time Warner was a bigger deal.
It depends on how you slice and dice it, you know.
But. Well, so what do you make of all this kind of noise that we're hearing with Google making overtures to Yahoo and Microsoft warning that if Yahoo doesn't play ball, it's going to take over the board and make it really hostile? Do you see that playing out, and that Microsoft does eventually land Yahoo, perhaps at a higher price?
I think the deal's going to get done. The question is, at what price? It's just good business on the part of Google to try to break this up or to make it even more difficult than possible, drag it out, make Microsoft spend money, make Yahoo uncomfortable, try to pick off talent from that company, create a lot of turmoil. That's just good business.
All right, Roger, what is it going to take to get the deal done, and talk about not just the price, perhaps, that Microsoft might have to pony up more money, but the regulatory side, U.S. and overseas in Europe?
Right. Before the regulatory issues come up, because we don't really have a deal yet, this is far from being a done deal, Microsoft has to get beyond Yahoo's board, and after Yahoo's board, then they have to go to Yahoo shareholders to approve of a transaction like this. Once a transaction is approved by all parties, then Microsoft and Yahoo together go to the antitrust regulators to get approval, not only here in the U.S., but also in the EU.
Where's it going to be tougher? We keep pointing out that the EU regulatory agencies beat the bejesus out of Microsoft for nearly a decade on the antitrust case over there.
Right. Currently, Google is seeking approval for the DoubleClick acquisition in Europe, and the EU has not given their opinion on that yet. They're still going through that. So they may face some Microsoft or Yahoo deal will probably face a little higher scrutiny in Europe than they will in the U.S. And that's what's probably going to happen.
David wants to jump in.
Very hard to argue anti-competitive, make that anti-competitive argument at this stage when Google has the market share that it does.
Well, but Google is pointing out that while it's not denying that it has about 75% of the online advertising search business, all right? But there's the display advertising side, which Google isn't strong in. Microsoft and Yahoo very strong in email. And in web services and in portals, and that's the case that Google is trying to make as it tries to block this deal. Will any of that hold water, Roger?
What the regulators will look at is each particular subsector of the industry when they think about competitiveness. So they'll look at email as a separate industry. They'll look at internet search as a separate industry. They'll look at advertising as a separate industry. And it's incumbent upon Microsoft, Yahoo, or Google to show evidence that there's not going to be any competitiveness decreasing any of those industries. What may happen, perhaps, this is so far off because there is no deal yet, but the regulators may say, for instance, if Microsoft and Yahoo come together, yes, you can do email, but you can't do internet search. And
so they might have to put in some safeguards or some Chinese firewalls or something to help segregate those businesses and protect consumers.
Correct.
But we were talking, David, to your point, to an internet advertising executive the other day, and he said, this is going to be great. These two companies, you're going to have Microsoft/Yahoo, and Google, and they're going to beat the bejesus out of each other, and prices for online advertising are going to come down.
Right. And just going back to the anti-competitive part, you know, the technology space, more than any other industry, it's all about innovation. And think about where Google was 5 years ago to where they are now. How can you argue that that a company somehow has a monopoly in this area?
All right, David and Roger, thanks for your insights this morning. We're going to get into whether or not there'll be some more mergers in the tech sector in another segment coming up here on Money for Breakfast. But now, here's Alexis and Liz with the Fox 50.